Hey, thanks for watching. So the federal government came out today with a new lending policy, a new mortgage lending policy, and they are now insuring properties of up to $2 million for refinance mortgages. These are mortgages that specifically are designed to provide funding for adding additional units to the property. So a basement unit, for example, or to create a driveway, to convert a garage into another unit, or a garden suite in the backyard, a small house. So an interesting policy and a pretty big number by allowing for a home to be insured for up to $2 million. The mortgage amount itself will be allowed to insure up to 90% of this $2 million value. So the maximum mortgage will be $1.8 million. And there are a few parameters that come along with this. So let's hop over to the screen here and go through some of those parameters and then have a quick discussion how this might affect the Canadian real estate market and the housing market and so on. So let's hop in here. So here it is. The mortgage insurance rule changes to enable homeowners to add secondary units, additional units. So this measure will apply to all borrowers seeking to access mortgage insurance in Canada to add more units. Borrowers must satisfy the following requirements. First, they must already own the property. So this can't be part of a purchase. Adding another unit as part of a purchase doesn't work. This is a refinance for a property that's already owned. The borrower or a close relative are the ones occupying the unit. So if you already own the home, you're living in it, you want to have some extra units, this would apply to you. Or interestingly, the way I read this, if a parent or a child was occupying the home, you could look at adding extra units. We'll touch more on that in just a minute. Obviously, the intent to construct additional units, that's the main purpose. The additional unit must not be used as a short-term rental. So long-term rentals appear to be okay. You can earn $2,000, $1,500, $3,000, whatever the going rent may go for in your area for a detached or basement unit. Just as long as it's not Airbnb'd. And this is in line with federal policy that made the taxation less favorable for Airbnb units for additional properties. So this is a refinance. This is not a purchase as mentioned. Insured refinancing will be allowed for the purpose of building additional units. That's the premise here. Legal units. So you can't just build the unit. It has to fully qualify with the municipality. It can be a basement suite with a separate entrance, laneway homes as mentioned, and they need to meet the municipal zoning requirements, building permits, checks on the construction and so on by the city as it's constructed. So the number of units, the maximum is 4 dwellings, including the existing unit. So in other words, there's already a unit there. There could be 3 more units built. Maximum property value limit as improved. This is a key term here, as improved. So when you add these extra units, whether it's a basement unit or a garden suite, that's going to add value to the overall property. And that new value, improved value of the overall property is the as improved value. So that value cannot be any more than $2 million. Pretty high number. I'm sure in some parts of GTA this is pretty easy to reach, and in GVA as well. But across Canada, it does give quite a bit of room to build an extra unit. What does an extra unit cost? Oh, maybe depending on the amount of work done, for a basement unit, $150,000 will get you a pretty good unit. $200,000 will get you a very acceptable garden suite unit, maybe a bit higher depending on where you want to go, or maybe a bit lower. Of course, it has to meet the municipal zoning requirements, which can add costs. But whether it's 200,000 or 300,000 or 150,000, quite a bit of room to work with here for a lot of properties. Maximum loan to value up to 90% of the property value of the as improved property value. So a $2 million property value doesn't necessarily mean a $2 million mortgage can be put on it. 90% of $2 million would be $1.8 million. So plus, a CMHC fee would probably increase that even more, but 1.8 million for all intents and purposes would be the maximum amount of lending, and probably the biggest constraint there would be the income to afford this. Now, maybe rents can be included. What will the market rents be on the as improved property? I could see that potentially coming into play. Really important question that's going to come up there, I'm sure, if people are creating units that they want to rent out. Can I use this $3,000 a month to help offset this mortgage? Can I work that into the mortgage as I'm qualifying for it? Probably the answer is yes, but we're still going to need to wait for those details, which I'm sure will come out close to January 15th when this actually launches. Maximum amortization is 30 years, so typically the CMHC had a 25-year amortization. Now we're going to 30. That does increase the affordability. By lowering the payment, it increases the amount of mortgage, which could be a good thing or a bad thing depending on how you look at it. Improving an existing property, probably leading towards a flexibility. You already own the property, you want to add an improvement to the property. Going to a 30-year amortization is probably going to help with that. Additional financing must not exceed the project costs. So kind of a no-brainer. Most people don't want their project cost to exceed the cost of financing. I'm sure it's happened once or twice in the past, but if the construction does go out of control cost-wise, then that financing is capped, I think is what they're saying here. So January 15th is when this comes into play, and so we'll have more information then. We'll be able to update on all the little details. Maybe different lenders will have different policies. Some will kind of maximize what this program allows through the CMHC, and some lenders may be more conservative in their approach. So we'll have all those details that come out. We're going to update you on that. So just some thoughts around this. I actually think this is a good policy overall. The federal government in the last couple months has come out with some policies that I don't think will be as significant as this. So I do think this will have an impact on the Canadian housing market. I do think that over the coming months and years, you'll see a lot of interest in this program, and you'll actually see it being used, and it has a lot of potential. It'll be interesting to see how it's used. I've already had some questions surrounding this today. It just came out today. What if I've got a larger property? What if I want to my adult child to build a secondary home on this property, a secondary unit, and probably that would work. So the way that would potentially work is that the adult child would have to come onto the title of the property, and they could help qualify for this mortgage refinance. That's one thing where the value of the land is so high in many cases. There's such limited zoning for new construction. This is just going to help in all sorts of ways to maximize or optimize the use of existing land. So I think we'll continue to see different iterations, different permutations of this come out. There will of course be limits. Not everything that we can imagine will be possible, but a lot will. And I do think this could have some impact on changing the face of the Canadian housing market, unlike some of the other policies that we've seen over the last 2 months, such as, allowing a first-time buyer to purchase up to 1.5 million, with just a massive mortgage, and who can really afford this as a first-time buyer, even with 30-year amortization. That will have some impact, but maybe not as significant as this could have. So really interesting policy here. Wanted to create this video to just keep a dialogue going. Thanks so much for watching. Please comment below, ask questions, and I'll try my best to get you the answers if I don't know them offhand. Thanks again. Have a great day.